Welcome to the Financial Quarterback with your host, Jim Lineweaver.
I'm Jim Lineweaver, your financial quarterback since 1993. While no one likes to see the current market turmoil, it may offer a golden opportunity for a Roth conversion. That's because your assets in a traditional IRA are probably valued at a lower level than they were previously, meaning the amount of tax you're going to pay on conversion will also be lower. So here to help me explain this strategy in more detail is Lineweaver Financial Group Tax Director, Mark Sipos.
Thanks, Jim. Before we get started with the strategies involving a conversion, let's talk about the differences between a traditional IRA and a Roth IRA. Both can be advantageous to the individual depending on their circumstances. Roth IRAs are funded with after-tax contributions, and those grow tax-free until the withdrawals begin.
Yeah, and those withdrawals are always going to be tax-free. So earnings can be taken income tax-free if you're at least 59.5 and have had the Roth IRA for at least 5 years. And there are also no required minimum distributions or RMDs ever on these accounts.
Right, and the Roth conversions seem to be the most appealing to people that are going to be in higher tax brackets when they retire versus what they are in currently. Also, the Roth IRAs will provide tax-free income in retirement, which offers a great tool to use and a lot of flexibility. But before we do any conversions, there's a couple factors that we need to consider.
And one of those is if you're in a year where your taxable income is lower than normal or your income is too high to contribute to a Roth IRA outright. So for these people, individuals are capped at $144,000, and also the phase out for married filing jointly is $214,000.
And another question you want to ask yourself is, do you have the cash on hand to pay those taxes that a conversion is going to affect you with? It's important to use outside sources to pay these taxes so that you take the most advantage of the full Roth conversion.
Yeah, and if you think the Roth IRA conversion could be beneficial to you, there are some strategies to consider. The first being to max out your current tax bracket. So let's say you're in the 24% tax bracket making about $150,000 a year. You won't hit the next bracket until your income exceeds $170,000. So you could convert the difference between these incomes and stay within that 24% bracket.
And another great strategy is to stretch these conversions out over multiple tax years. This will help you budget and control the taxes, and as you mentioned, take great advantage of that marginal tax bracket.
Yeah, and this is where you might want to get in front of some of these tax changes. So if a law is coming down the pipeline and could unfavorably affect your future taxes, you could potentially avoid paying more taxes on the conversion by converting some or all of your traditional IRA in the year before that change.
And no one can predict what the future of the market's going to be, but the market is down right now. This makes it a great opportunity to discuss these Roth conversions so you get the greatest impact of the most money going into a Roth, as well as limiting your tax impact.
Yeah, and this strategy has to be implemented before the end of the year. So if this is of interest to you, give us a call. Here's Fox News Sunday.